Off its two-day meeting, but for now, let's bring in our expert floor show. Joining me now, trader Keith Fitz-Gerald and Duke University finance professor and economist Campbell Harvey. Campbell is the father of interpreting the inverted yield curve as a recession indicator. However, we should show this. Treasury yields have been inverted, meaning shorter-dated T-bills are yielding more than longer-dated ones for the longest stretch on record, 400 days. And so far, no recession. Harvey, this has been the most incorrectly called recession in recent years, Campbell rather, in recent years. Is the inversion thesis a failure this time?
I think it's way too early to declare a failure. If you look at the last 8 recessions, the maximum lead time is actually 23 months. So to go to the historic maximum, we'd have to wait until October. And there are a few recessions with 17-month lead times. We're at 19 right now. So we're not even outside the historic range the way I calculated based upon monthly averages. You just presented dailies, but in terms of monthly, we're still not out of the woods. And there's plenty of indicators out there outside of the yield curve that are pointing to a potential slowdown, including the jobs number today.
Okay, so let's just explain. When you're talking about a yield curve inversion, that basically means shorter dated treasuries, and you go by the 3-month, are yielding way more than longer dated, the 10-year. And the difference right now looks to me to be about 97 basis points. The 3-month yielding 5.39%, 10-year yield 4.43%. Keith, you as a stock trader, how closely do you watch this, or do you just ignore these kinds of signals and dive into what you think are the best companies out there?
Well, that's an interesting question, Liz, and it's changed a lot over the years. When I first started in this business and dinosaurs roamed the earth 40 years ago, that was a very important data point. But as the amount of liquidity has increased, increasingly that data point is a sideshow. I'd rather concentrate and spend all my time on finding great companies that are going to profit despite it all. So it's important, but beyond that, a source of amusement and not much else.
Well, a source of amusement or excitement for anybody who invested, like you, Keith, into NVIDIA. We can put that up there right now. NVIDIA not doing as well, certainly today and yesterday, as investors would love to see. But we've got the stock split, 10 for 1, going into this session, and I'm looking right now, Campbell, at the equity market, which will close to the upside across the board, Dow, S&P, and NASDAQ for the week. What can you interpret from this inverted yield curve about the equities market, which has continued to climb, march ahead?
So let me just say that the inverted yield curve is a single indicator. It's really simple. As you said, the difference between 10-year and 3-month yields. So I think it's naive to think that you would use just one indicator to forecast what's going on in the economy. However, I would be hesitant to call something a sideshow when it is delivered 8 out of 8 with no false signals in predicting recessions. So it is a piece of information that should be used along with other information. To use it alone, I think, is a mistake. You need to consider the broader picture. Today was an interesting day with the jobs announcement, which you've talked about extensively, but it's interesting to me that most of the spin is on the establishment survey number rather than digging deep into the household number. And there's a number of things that we consider red flags.
Professor Harvey, Keith Fitz-Gerald, great to have you on this very busy Friday. Folks, the boots and poles may be put away for the season, but one company's stock is sliding off the backside of the mountain. We're going to tell you why Vail Resorts is seeing an avalanche